Welcome to the Deep Dive.
Glad to be here.
So today we're taking a stack of sources, earnings previews, profit reports, even a pretty hefty annual report.
Yeah, that 10K. Lots to unpack there.
Exactly. And we're going to try and pull out the essential info you need about the recent Q1 2025 results for Morgan Stanley and Wells Fargo.
Right. But it's not just about the numbers, is it? We're really looking at what this might mean going forward. Future trends, potential impacts.
That's the goal. Trying to see the bigger picture for these banks and, well, maybe the wider economy too.
And we really want you involved in this. As we go through this stuff, think about your own take.
Yeah, what jumps out at you? What questions does it raise? Definitely let us know your thoughts afterwards. We want to hear them.
Absolutely. Your insights make this whole thing better.
Okay, so ready to dive into those Q1 headlines. What did the initial reports actually say about performance?
Well, looking at the sources, Morgan Stanley definitely stood out. Source 2 flagged their performance as particularly strong.
Strong feels like maybe an understatement. I mean, the numbers were pretty impressive, weren't they?
Yeah, they really were. Source 2 showed significant year-on-year growth. Revenue was up, 17.2%, reaching $17.7 billion.
And the bottom line?
Even better, net profit jumped, 26.5%, landed at $4.3 billion.
Wow. So that EPS figure must have climbed quite a bit too.
It did, sharply, from $2.02 up to $2.60 per share. Source 2 actually called it the strongest growth among the banks they looked at for that quarter.
Okay, so headline-wise, a very, very strong start for Morgan Stanley.
Definitely.
So how about Wells Fargo? How did they look in Q1 according to the sources?
Source 2 said they also posted solid first quarter profits for 2025.
Right, and I remember Source 1 gave some context on the forecast going in. They were projecting revenue around $20.76 billion.
Which was actually slightly down from the year before. Q1 2024's $20.86 billion.
But the projected EPS was slightly up, wasn't it? Like $1.23 versus $1.20?
Exactly. So when Source 2 confirms solid profits, it suggests they generally hit or maybe beat those profit expectations, even if the top line, the revenue, was kind of flat or slightly down compared to a strong Q1 last year.
Okay, solid. But what's interesting is the commentary that came with it, right? From the CEO, Charlie Scharf.
Yes, that was really telling. Source 2 captured that. Despite those solid profits, he immediately seemed to pivot to the outlook. Said the bank's expecting a slower economic environment ahead.
A slower environment. That's a pretty clear heads up.
And he didn't really pull any punches, warning about growing economic challenges. Source 2 links it to things like, inflation, trade policies, global volatility. The usual suspects, maybe.
Did you touch on trade specifically? I recall something about that.
He did, yeah. Mentioned looking at barriers to fair trade for the U.S., but crucially also acknowledged the risks involved if significant actions were taken.
Right, so it paints this picture of doing okay now, but definitely keeping a very watchful eye on the horizon.
Precisely. And that's the tension, isn't it? You've got these solid Q1 results, Morgan Stanley's strong growth, Wells Fargo's solid profits, but happening, as Source 2 puts it, amid economic uncertainty.
Yeah, that phrase captures it, and the CEO's caution really drives that home.
And Source 2 also mentioned rising jobless claims as another piece of the puzzle, sort of backing up this idea of a more challenging backdrop.
So Q1 looked okay, maybe even great for some, but the folks in charge are signaling caution.
Which leads us right into the deeper dive, looking past Q1 at those future trends and impacts. This is where the other sources, especially that Morgan Stanley 10K Source 3, become really valuable. They lay out the potential headwinds.
Okay, let's get into that forward view then. The 10K, it's dense, but it's got the details on the risks they see. What are the big categories?
Well, we can start with those economic headwinds the Wells Fargo CEO mentioned.
Yeah.
Source 3 confirms, banks like Morgan Stanley are just deeply tied to the broader economy. Inflation, global issues, slower growth. These aren't abstract for them. They hit the business directly.
And Source 3 gets specific on market risk too, right? Which for a firm like Morgan Stanley, with all its trading.
Exactly. Trading and investing activities carry market risk. But it also talks about non-trading market risk, like interest rate risk.
Ah, okay. How does that play out?
Well, think about areas like wealth management lending. They hold loans on their books, right? Source 3 says that part of the balance sheet is generally asset sensitive.
Meaning higher interest rates could actually help their income.
Boost net interest income. And this is an interesting detail in Source 3, that sensitivity has apparently decreased recently.
So higher rates might not give them the same lift in that area as maybe they used to.
Potentially, yeah. That subtle shift, even if it sounds technical, matters for how different parts of the bank react to rate changes.
Got it. Okay, so economic and market risks. What's next? I imagine credit risk is a big one.
Huge. And Source 3 spends a lot of time on it. It's, the basic risk that borrowers default or the collateral backing loans loses value.
And the source points to one area in particular.
Very clearly. Commercial real estate, CRE. Source 3 states their allowance for credit losses, the money set aside for potential bad loans, went up in 2023.
Okay.
And it says that increase was primarily related to deteriorating conditions in the commercial real estate sector.
Wow. Okay, so they were already building reserves before Q1 2025 because of CRE worries.
Yes, and specifically mentioning the office portfolio within CRE.
Which makes sense given everything we hear about return to office struggles and vacancies.
Exactly. Source 3 also noted that some actual loan losses, charge-offs, in 2023 were tied to CRE and also corporate loans. And looking ahead, it mentions U.S. GDP is a sensitive factor in their credit loss models.
Meaning if that slower economy the Wells Fargo CEO talked about actually happened.
Or is maybe worse than expected, their models could start flashing bigger warnings about potential credit losses, especially in those vulnerable spots like CRE.
It really shows how these risks bleed into each other, doesn't it? Slowing economy hits businesses, makes it harder to pay rent on offices.
It's all connected.
Okay, so economic, market, credit risks. What about external forces, like regulations? That always seems to be a major factor for banks.
Oh, absolutely. It's a constant presence and source of change. Source 3 talks about the comprehensive capital rules they operate under, mostly based on the international Basel III standards.
But there's something new coming. I think Source 3 mentioned an endgame.
Yeah, the Basel III endgame proposal came out in July 2023. And it sounds pretty significant.
Endgame. Sounds final. What does it propose, according to the source?
Basically, substantial changes to how banks calculate their risk-weighted assets, which is key for figuring out how much capital they need to hold.
Okay.
It pushes towards using more standardized methods across the board. This new expanded total RWAs measure sort of replaces the old approach where banks had more leeway to use their own internal models.
And the big takeaway from Source 3 on this is?
Uncertainty. Plain and simple. The impact is just uncertain because it all depends on the final rules that U.S. regulators eventually adopt.
So they know of potentially big changes coming, but not exactly what it looks like or how much more capital it might require.
Exactly. Could be significantly more capital needed, but the specifics are still up in the air. And that makes future planning, especially around capital deployment or shareholder returns like dividends, well, much trickier. Source 3 notes regulatory limits can restrict those actions.
Right, so it creates this planning headache on top of everything else.
Precisely. And it's not just Basel. Source 3 mentions other ongoing regulatory stuff like resolution planning, basically their living wills. Morgan Stanley's next one is due July 1, 2025. So it's a continuous process.
Okay. Beyond the financial and regulatory maze, what about operational risks? Things going wrong internally?
Source 3 covers that too. Operational risk is pretty broad.
How do they define it?
Source 3 describes it as the risk of loss or, importantly, reputation damage from things like inadequate or failed processes or systems, human mistakes.
Human factors.
Right. Or external events. And the big one they highlight there, cyber attacks.
Which feels like a constant threat now, especially for a global bank.
Absolutely. Source 3 flags cyber attacks and security breaches as major worries, given their global reach and transaction volume. And it includes this rather chilling note that breaches could happen and go undetected for a long time.
Oof. That's not comforting. Significant damage could be done before anyone even knows.
Exactly. And Source 3 also points to the human element again. Even with good controls, mistakes happen, misconduct happens, and that can lead to big losses and hit their reputation hard.
So internal processes, systems, people, and external attacks. A lot to manage there.
Definitely. And finally, Source 3 touches on the competitive environment.
Right. How's that looking according to them?
Well, it's always changing, isn't it? Source 3 mentions ongoing consolidation among traditional players, but also, crucially, the disruption from fintechs.
Yeah, the smaller, nimbly players focusing on specific areas.
Exactly, and that creates pricing pressure as everyone fights for market share. Plus, Source 3 makes an interesting point, that some of these competitors, maybe the newer fintechs or non-bank lenders, might not face the same level of tough regulation as the big established banks.
Putting the big guys at a potential disadvantage.
That's the implication mentioned in source 3. So competition from everywhere, plus maybe an uneven playing field, regulatory-wise.
Okay, so let's try and synthesize this. We started with Q1 2025, strong growth at Morgan Stanley, solid profits at Wells Fargo, pretty good headlines.
Right. But then you layer on the CEO's cautious outlook about the economy.
And dive into the detailed risks laid out in source 3, that 10K. And the picture gets, well, a lot more complicated.
Definitely. It's that contrast. Present strength, but looming future challenges. Those deteriorating conditions in CRE, the big question mark over the Basel, the endgame capital rules. These are specific, significant headwinds they're flagging.
And source 3 emphasized how these risks aren't siloed, they're interconnected.
So managing them effectively, using their whole risk management framework to deal with credit pressures, regulatory changes, market swings, cyber threats. That's going to be absolutely critical for them in the coming months and quarters.
It's not just ticking boxes on risks, it's actively navigating this complex web of known pressures.
It seems like a major challenge for sure.
So when we look at all these sources together, the story seems to be solid Q1, yes, but clear storm clouds gathering. Economic uncertainty is real. Credit risks like CRE are a known issue. Regulations are shifting in uncertain ways, and operational threats persist.
That really sums up the key message coming out of these documents.
And this leads to, I think, a really interesting question to ponder. Given that solid Q1 performance, but also these clearly identified significant risks ahead, the Basel III endgame, ongoing CRE issues, the competitive shifts, how might these big banks need to fundamentally adjust their strategies? Are the risk management approaches they describe in these documents truly enough for the specific challenges they themselves are highlighting?
That's a great question. A really crucial one to think about. Are they geared up for what they know is coming?
Definitely something to mull over. So we've done our deep dive into the sources provided today, trying to pull out the key nuggets on performance, those future risks, and the general outlook based on these reports.
Yeah, we covered a lot of ground, trying to connect the dots between the headlines and the fine print.
But we really want to hear your take. What stood out most to you? Did anything surprise you? What questions does this raise for you about where banking is headed?
Please do share your comments. Let's keep this conversation going.
Until next time, stay well informed.